Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, everyone. Welcome to this week's Massive Passive Cash Flow podcast. The podcast for investors who are typically professionals, business owners, and you really don't care so much about all the no money down stuff. And we do it. We're not knocking no money down investing. But the fact is, we know if we can get you on a cash basis, we can help you get a lot better deals. And later on, you can get creative and pull your money out through creative financing. So there's definitely a way to do it. And that's what we focus on, is what we teach, mostly in the United States, also in Canada. In fact, if you have not subscribed to the podcast, please feel free to do so. Being downloaded in, I think, more than 50 countries now. And of course, it doesn't cost a single dime. So go ahead and do that. Stitcher, iTunes, iHeartRadio. Oh, by the way, if you have not been to the website, realestatewithgarywilson.com, click on members area. If you're a member, you know what to do. You go to the left, you log in, you get access to all the goodies. If you're not a member, go to the right and get yourself a free 30-day peek behind the scenes. And what that gives you is not just all the goodies, the books and all that stuff, but all those investor agents we've been training for the last decade, they're out there on a community site for you. And we've got several hundred right now currently active in 24 different states, ready to help you and I find the good deals. They're not traditional agents. They're not necessarily residential, not necessarily commercial. They focus strictly on us investors. They're trained and certified. I know it because I'm the one who certifies them. So take a look at that. Do yourself a favor and build your team the right way. Now, for this week's podcast, we got a special guest. Okay, so she hails from Colorado, Stephanie Walter. Interesting background, and I'm glad to have her on here. So Stephanie, welcome aboard to the podcast. I appreciate you taking your valuable time to this. I know you're busy, and I know this is a big gift for us. So thank you very much.
Well, thanks for having me. I'm excited to be here.
Yeah. Hey, if you wouldn't mind, I mean, there's a lot of questions I want to ask you, but would you mind starting off just painting a picture for us? I know you're in a beautiful state of Colorado, but give us a little background. Paint the picture of Stephanie Walters for us, and then we'll get into some meat and potatoes. How about that?
Yeah, that sounds great. Well, I'm a Colorado native. I quit my W-2 job in 2006 to start an insurance agency. I continued to invest in single-family homes. But in 2016, I became really interested in learning about syndications, doing larger deals, because I'd been approached by a lot of my friends and family. They saw how well I was doing and wanted to participate. So just started syndicating deals around that 2016 time. And from there, I have been raising money. That's sort of my niche in this world. And by doing that, I've learned a lot about dealing with wealthy people and what they do with their money. And by implementing some of those strategies, I just sold my insurance practice in December of 2020, and I'm all but retired.
Wow. Well, First off, congratulations.
Thank you. Thanks.
You're living the American dream. And I'll tell everybody listening out here, all the dentists and chiropractors, and if you own your own business and consulting, I think there's going to be an excellent podcast for you to really pay attention to, because Stephanie's actually done it. She lived the dream. And at the end of the day, one of the most important decisions you ever make if you have a business is, what do you do with it?
Yeah.
So kudos on that. If you wouldn't mind, you mentioned a couple of hot topics there. Actually, let's start here. I'm going to kind of jump around a little bit. I noticed when I was studying about you, you have one subject that's basically going to sound counterintuitive to people, but I really want to dig into it because I think it's so vitally important. And that is, what are the reasons to not put your money into a 401k?
Yeah, that's really interesting. Like I said, I deal with accredited investors. Those are people with a net worth of over $1 million. Many times they're people that are wealthy, have a lot more wealth than that. And what I noticed was really interesting when I'd look over their financial statements is, virtually none of them have 401ks. As I get to know them and their personalities and just their philosophies about money, that became very interesting to me, is they don't view their money as, okay, we're going to accumulate it and let someone else take care of it, and just wait for it to get into it. We want the money right now. We can do better ourselves. And they use their money as a tool. They look at each investment and they look at, what is this going to give back to me specifically? And mostly all the time, they're looking at what cash flow they get. And by changing that mindset a little bit as far as accumulation versus cash flow, that's what I did in my own life, because I had a lot of rentals that, they made okay, rent, but I still had about 20 years to pay on all of them. But then when you start examining some of these other deals, which is what the wealthy, they invest in businesses, as you mentioned, compelling pieces of real estate, usually syndications. And when you look at the returns you get in that environment versus the returns of the money just sitting in your equity, it's kind of a no-brainer to take that money and put it where it's going to work for you and give you cash flow. And they view cash flow, I think, largely as more important than their net worth. I think everyone would tell you that, because in my case, now my cash flow has replaced my business income, which allowed me to retire. So that's kind of a powerful thing.
No, it definitely is. And what's interesting is most people. Well, here's a good example. You remember Joan Rivers?
Yes.
So here, when she lost her husband, I looked at this. I think it was like a documentary on her life or something. And one of her closest friends, who was also her husband's, I guess, financial planner, tax accountant combined, he said, "You know what, Joan?" He said, "The fact is, you're an extremely wealthy person. The challenge is you have a lot of net worth, but you have no cash flow, Yeah. And it's a huge difference. So what I like to have is what I call income producing assets that hold value and also throw off income. Of course, in the stock market, that's typically your blue chip stocks. But in real estate, it's strip malls, it's storage facilities, it's even single family homes, things like that. But you're right, a lot of wealthy people I've known, they'll do stuff with whole life insurance, but almost none of them had 401ks, and they would use the life insurance as a leverage tool, and they would be able to take the assets they had in real estate, like land and buildings and so forth, and collateralize a loan. So the life insurance company would let them borrow against like not the cash value of the policy, but the payout value. And I never knew this before. I was like, well, that's actually ingenious, But that's just not the subject of today, of course. But the wealthy have. They look for other alternatives to grow income streams, and that's what I want to do, is get into more of that now, and maybe talk about leverage and how some of the wealthy are using what they have. So which leads me to and by the way, just quick before I jump ahead here. I know that in the last several years, I used to be a 401k holder years ago. I was in corporate banking, built up the big giant 401k, started borrowing against it. And then I got to a certain point, I was like, you know what? I'm going to actually take the penalty. I know this sounds crazy. Why would I pay a penalty? It's because I was able to do much better on my own with the cash. But back to what I was jumping to next is the legacy banking concept for real estate investors, and how investors can take further advantage of their real estate holdings. And when you were talking about what you were saying, they didn't have 401ks. I instinctively went to legacy banking, and what I was mentioning a moment ago is probably another way of doing that. But if you could expand on that a little bit and do a much better job than I could ever do of speaking about it, that would be awesome. So, because I've been a consumer of it, an observer, but I really want to learn about this myself.
Yeah, no, you did a great job of explaining it. I mean, I think, again, you mentioned your 401k and you thought that might have not been the best idea to take it out and pay the penalties. I would argue against that. I did the same thing because a big question mark you have with the 401k is, what is the tax rates going to be in 20 years? And you know darn well they're going to be a lot higher. So I think it is smart to, if this is the strategy you choose, to go ahead and take those penalties and use the money yourself. I guarantee you'll do better investing in, like, a typical syndication we have gives people an annualized return of around 19 to 25% a year annualized.
Wow.
You're going to get a much better return doing something like that than keeping it in the stock market. But no, to go to the legacy banking, that came from my background in insurance. And though a lot of normal insurance agents don't really know about this, it's actually very, very much utilized by the wealthy people. And what it is you purchase insurance. It's, again, very anti-intuitive. You buy the most insurance or the least insurance that you can for the most amount of money. So you shove as much money into this vehicle as you can. The government does give us a limit to what you can do, how much you can put in there. And then that money is builds up a cash value. Or, I mean, I have people that put like $150,000 in there. And then in 30 days, say they see something they like, they see a syndication they'd like to get involved with. Well, they just pull the money out of that policy. The policy remains in force, and they're able to invest in this deal. The cool thing about it that we talk about, wealthy people understand that their money is a tool, and the best way of having a tool is having your money work in several places at the same time. I mean, the most ideal thing would have the same money making places in two vehicles at the same time. And that's what this accomplishes. So it can be invested in a syndication, making, 20%. But then it still accrues money in the cash value life insurance. It's tax-free. And that amount can be anywhere, depending on the vehicle, between 4 and 6% compounded interest, tax-free. So when you put those two together, it's, that this is why the wealthy become wealthy. And the beauty of it is they use that money during their life. A lot of people think of life insurances for the people after you passed on. This policy is living benefits. So you use the benefits while you're alive. You can virtually drain the policy because you're able to take the money out tax-free. I tell people it's very similar to like a Roth, except there's no limit to what you can put into it. So everything you take out of it is tax-free. And then you've taken it out and you pass away, and you give your family $1 million when you die. And the trick, the secret is that is what the truly wealthy families do to pass their money from generation to generation. A great book by Garrett Gunderson is called What Do the Rockefellers Do? And it's a great book about what the Rockefellers have done versus what the Vanderbilts did. And the Rockefellers very much believe in this philosophy, which is why they're wealthy. Their family is still wealthy, whereas the Vanderbilts have pretty much, gone through everything that they have. Yeah. So it's an interesting strategy.
And what was the Garrett Gunderson? It was what the Rockefellers?
What do the Rockefellers do?
Okay. I'm writing down because I'm a huge reader. I'm a big nerd. And I love to read.
Yeah, that's a definite. That's a great read.
Okay. Yeah, and great legacy and great history. I'm a huge history nut. And so let's do this. I want to dig a little deeper if we could. Like you gave a broad example there. So if you have a case study, of course, change the name to protect the innocent, right? Case study or example. And then what happens inside the whole life policy is, I'm guessing it's whole life. So the cash value, if you pull it out, are you actually borrowing against it, or are you actually extracting the funds itself? And can you put it back in? It still grows. Some details like that, because I know there's a lot of people listening, and I think, Stephanie, this is such an awesome topic. I think you're going to get a lot of interest out of this because of the people I know that listen to the podcast. And this comes up like on a regular basis, like, who can I talk to? Can you give me an example? So if you wouldn't mind sharing one, that would be awesome, you know?
Well, you could put, I guess, the example I just used is someone to put $100,000 in there. So we think of it, you think of it as borrowing the money out. That's actually not the case. It's technical, but it matters that you actually borrow the money from the insurance company. And that way your 100,000 still stays in the life insurance and still accrues that compounding interest. The beautiful thing is there are no requirements. So say you build $100,000 or $200,000 out in there, and you want to buy a house, buy a rental property. It's a completely flexible loan. You don't have to go and talk to anybody about your credit. You just pick up the phone and say, I'd like $100,000, and a week later you get it. There's no, you don't have to pay the money back in any way. And so there really aren't hard and fast rules about it, other than you can, as long as you fund it, that's really the key, is funding it correctly and appropriately. And really, to do that, you have to work with someone that understands this product. You go down to, I was a farmer's agent, you go down to a farmer's agent's office and ask them about this, they won't have a clue of what you're talking about. But a lot of people think you need to just pay on this life insurance until you die. That's not the case. We just really try to work a lot with business owners, like, what do you want to do with this money? And it's really a tax sheltered vehicle for people. And you say, I want to put $500,000 in here over 5 years. You never have to put another dime in after that. So, some people want to pay their premiums for the rest of their lives. Some want to just pay them up front and never think about them again. And so it's a very flexible product to do what you want. But also a nice thing about it is people decide to put their money in there as opposed to a 401k for a really great reason, which is when you pull the money out, it does not, the government does not look at it as income. So it does not affect your ability to collect Social Security, if anyone in this audience thinks they're going to get Social Security. But it is not considered provisional income. So that means that your Social Security would never be taxed if you set up a product like this.
Wow. Yeah. And other thing too, I'm thinking is probably, like, if you were to run a credit report, I wonder if it even would show up as a loan on a credit report.
It does not.
Isn't that amazing?
It does not. Yep, It is amazing. And these companies, people are like, well, I've never heard of these companies, because most people haven't. They've been around, many of them, since before the Civil War. And if you look at their history of paying their distributions and dividends over the course of, they've never missed a distribution payment. They're not linked at all to the stock market. The funny thing is that the insurance companies do exactly what some of us do, which are syndications. They send their money out and they put them into big multifamily, big commercial spaces, and they just want to do a little bit better. So it's very safe money. It's not at all tied to the stock market, which a lot of people like.
Yeah. Well, this is awesome. Now, relative to that, are there any other related? Here's what I'm getting at. You always ask this question. Hear people say, "What do the wealthy do differently in regards to money and their investments?" And this is one thing we're talking about. But let's say they've done family does this. They start the policy. They put the money in, then they borrow against it. They borrow it out actually to buy an investment property. What happens with the investment property? How is that titled? What's the ownership? Is it a trust and their kids are beneficiaries? Like what are you seeing there? It might be a number of things, but what kind of things are you seeing on that end of the transaction?
They can buy it however they want. Just think of you taking the money out as cash. And so there's no tie to the life insurance policy at all. So you can buy it and put it in your name and your trust name, anything like that. But the insurance company won't even ask you what you're using it for. So there's no tie to them as far as that loan goes. Yeah.
It's amazing. They're not so the insurance company doesn't fall within the direction of the banking industry. In other words, the federal government has a control of the currency and they have banking regulators, but it's definitely not banking. So they don't have to follow FHA rules, and they don't have to ask you, well, what are you using the money for? And they don't have to report it. I mean, this is all an amazing advantage to a lot of business owners out there, because it doesn't, it's almost like it's quiet. It's like a quiet transaction. It's under the radar screen.
And it's sort of like, I use the term as it's almost like their own bank, the person's own bank. They go in and they use the money as they see fit, and it operates very much like a bank, their own personal bank. Yeah.
Okay. I got a few more questions if you don't mind. We're on a roll here. A couple of side questions. Here we're watching the economy now, where everybody's watching what's going on in the news, and the virus and immigration and the mortgage interest rates just went up 2 or 3 weeks ago by a full third, by the way. Gas prices are going up like crazy. So everything now that has to be shipped and delivered, building materials, all that's going to be more expensive. But as far as timing, have you noticed anything in your in this business model relative to timing? Like, in other words, you do it more in a down market, you do it more in an up market. Does it really matter what the market's doing? Or so as far as timing goes, any insight on that regard?
There isn't really much as far as timing goes, because their interest rates that they pay don't fluctuate very much. They stay pretty stable. So I think as far as the market goes, I think people, my age and older possibly and younger, really need to think about taxes. And that is, again, something that wealthy people really think about, that the average everyday person does not think about. And what are taxes going to look like in 5, 10, 20 years? What happens in this vehicle is once the money's in, it is the money grows tax-free, and the distributions are tax-free. So it's really, like, I think, a great time to consider them, because just, to get your money into a sheltered vehicle, and with so much flexibility, it's just a great thing.
Yeah. I tell you what, it's funny that, one of the major themes going through my head right now is, I learned early on how to make money. I learned how to build wealth and income primarily through real estate again. But I also learned this, and that becomes the easy part. It's actually, the difficulty comes into how do you hang on to it, and understanding taxes, and this method here using life insurance are major strategies, because if you don't have a defense, you got an offense, and the offense is putting points on the board, building the wealth and income. Defense is hanging on to it. If you don't have a defense, I'm telling you, the tax man's going to come knocking. You're going to have marketers, because of the way merchant companies sell your information. The credit card company doesn't sell information. The underlying merchant business does. So you wonder why when you go, get a subscription to Fortune magazine, all of a sudden you start getting all these ads about buying yachts and buying Rolls Royces and Rolexes and things like that. It's not magic. So hanging on to it's a big thing. Now, as far as if you can maybe debunk some of the money myths, because I know a lot of people who are not familiar with these methods and techniques, they'll say things like, well, rich people are lucky, like they already were born rich and they're just lucky. So that's not necessarily the case. But what are some of the big myths you've seen that we can dispel here? One or two of the main ones relative to all this.
I think we've talked about a few of them, but the one that comes to mind to me is just a mindset view of money. It sounds, kind of goofy, but it is the truth. People that have money, wealthy people, don't look at their money as just accumulating it. We're accumulating it here in this, wherever it ends up being. Mm-hmm. They're always using their money. Their money is a tool for them. They are always investing it and looking at the quicker that they can turn around their investments over and over again. I think the 401k is the one that we've been sold in this country, and there's so many things about it that make it not good for people. Especially that you tell someone you have $1 million in your 401k. Do you really have $1 million? Like, how much do you really have? Because at the end of the day, you're going to have to pay taxes, and we don't know what those tax rates are going to be. And I think also you're saying that wealthy people are super intelligent, not to disregard, or say that they aren't, but I certainly believe that they believe that they can do better with their money than someone else can. And they're able to look at a deal and they analyze people. They really look at investing, like in real estate, in teams of people. They believe in businesses, those types of things, rather than investing in the stock market, which who knows? I still have yet to have anyone that understands the stock market really say that they know what's going to happen in there, which to me, that makes it something I don't want to invest in. I want to invest in tangible assets that can be collateralized, and I know what they're going to do and why they go up in value and why they go down in value too. So
it's funny you mentioned that. Back in the last recession, Stephanie, I had Wall Street guys coming to me. They were running from Wall Street and running to real estate. And one time we actually set up our own closed-end mutual fund to buy portfolios of properties instead of stocks and bonds. It was real estate, and had a number one tobacco commodities broker in the world. He contacted me and he said, "This is what I want to do." And I'm like, and I was, thinking, thankfully I learned from Richard Branson, who says, when opportunity comes your way, you say yes. You figure it out later. I realized, okay, I don't know I have a clue what this guy's talking about, but I said, yes, I'm your guy. And he said, then he laughed. He said, "Don't worry, I'm going to share everything you need to know." And big lesson for me, my gosh. But in any case, so if you could, and that was a form of syndication, by the way, obviously, if you wouldn't mind, would you mind kind of giving us a little bit of background on actually what is syndication? Because people hear it all the time, and they probably don't realize how simple it really is. If you wouldn't mind, maybe, description and maybe an example or case study would be awesome,
Sure. Yeah. A syndication is just a group of people that decide to buy a large piece of property. For us, that usually means multifamily apartment buildings. We buy them in what we call emerging markets across the country. The cool thing about apartments is the value of the apartment is based on the income that you get. So if you're able to find a property and say they're not charging a market rents, 100-unit property that we can raise each of those 100 units by $50, depending on, the cap rate in the area, we've just added over $1 million of value to that asset. So that's what we do on a 1 to 2 times a year. We find a really undervalued property. We bring investors in. They're considered passive investors, so they don't have any responsibilities for the toilets, the tenants, the 2 a.m. calls. They are just sent a distribution check every month. From when it's acquired, we hold the property from 3 to 5 years. We sell it, and then we give. Everybody gets, like I said, about that 20% return on their investment annualized over the whole. And if we have several, like I said, we have 1 to 2 opportunities a year. So if you have any interest, you can always check out my website, which is www.erbe.com. That has the legacy banking on it, but it also has our past and present deals, just so you can kind of see. But it's actually, syndication are like, well, I've never heard of it. It's been around forever, and it's actually something that the wealthy and the the banks and insurance companies have taken advantage of for years. So even big pension companies do it. So it's a very solid investment.
Yeah. Well, I appreciate it. It was interesting for everybody listening here. When I was first introduced to Stephanie, I thought, I wonder if she's part of Jerry's group. My tax account's name is Jerry Erbe, the same exact last name, ERBE. So interesting, small world there. But hey, I want to have one more question, if you don't mind. We mentioned, like the guys on Wall Street, New York, you're in Colorado, I'm in, all over, but Virginia, Florida. But have you noticed, are there parts of the country, like you mentioned, you like to look for emerging markets? Are there states or MSAs that pop into mind, like the top 1 or 2 or 3 that you look in? I mean, I know where you are. That Colorado market's been going crazy for the last generation, So
it has been, but actually Colorado's not one we look at. We look at probably hundreds of different factors when we go into a community to look. And I'll tell you, the last ones we've done have all been in Florida. I mentioned to you before that I love Florida. Tallahassee, we have had 3 properties there, and they have just done amazing through COVID and everything. But you have to think, we followed, places where people are moving. The economies there are growing. If you read anything about Florida. So Florida, Texas is where largely our assets are located. It also has an effect of who's running the government there too. I know that's not a popular thing to talk about, but Florida kept their economy open, and that was a huge factor in our investments doing so well. And in fact, we have a new offering that is located in Broward County, where they say a lot of this California tech markets are moving to. Enormous amount of wealth is moving into that area. So, and my partner lives in Florida, so it's a great fit down there.
Yeah. Well, you can see by the tan on my face, it's such a wonderful place to be. I was here for just 17 days and can't wait to get back there in May. But I tell you what, this has been an absolute wealth of information. I wish we could keep going. And I think I'm going to have you back on, if you don't mind, Stephanie. There's usually a couple of months of inventory we have to go through. But if you wouldn't mind, you mentioned your website. Any of the things you can offer people, words of wisdom, how can people get a hold of you? Because I think you're going to probably people are going to ask you for some one-on-ones out of this. I'm gonna.
Yeah. Well, no, I'm happy to do it. You can go to my website, which is www.erbewealth.com. And on there is all of my information. You can email me, or you can call me, but also you can download. I have a report that it's the 5 reasons why passive investing might be for you. And so for some of those people that weren't quite understanding the syndication, really breaks down all the reasons why it's an amazing way of building wealth. It also gets into the tax benefits, the appreciation of these properties, and inflation, all the checks off the box that make this a good investment to at least look into. And also on the website, we'll show some past investments and some real returns that we've had on our past properties. So nice. Yeah, it does have stuff like I mentioned about the life insurance as well.
Yeah. What a great combination. I mean, legacy investing, utilizing a common product, insurance, life insurance, and investing in real estate, the one true form of investing that involves income-producing assets, tangible physical assets that throw off income, and it just gives you so much more control and leverage ability that you just can't get in the stock market. It's funny, everybody argues against the different angles, and they're all right, but the thing is there's not much you can say that compares with the level of control you have by doing it this way.
Yep. So. And that's about what we need is more control of our money, because you're going to do a lot better yourself than some financial planner that probably never looks at your portfolio, maybe once a year.
Yeah. And you sure don't want government doing it for you, because just look at Social Security. No. That's the government's big example of,
Yeah. So, exactly.
Yeah, that's just part of being free, is you have freedom of choice and can make your own choices, own decisions. And so in any case, well, I tell you what, I think I speak for a lot of people, Stephanie, when I say thank you from the bottom of my heart for taking your precious, valuable time to this. I know you're successful, and I know how valuable this is having you on here. And I can't wait to have you on again. And everybody listening, man, take Stephanie up on the offer. Go to the website, check it out. Okay, she's got a book on the subject, and you can never learn too much. So start with a book. And again, if you haven't subscribed to the podcast, please feel free to do so. Stitcher, iTunes, iHeartRadio, 30 different channels. Go to the website, realestatewithgarywilson.com. Go to the YouTube channel, same name. 16 channels, hundreds of videos. All just get as much as you can get for free. And I do the Monday night class, so that's open to the public now too. But we'll see you there. We'll see you next week. In the meantime, take care of yourselves. God bless you and your families. And we'll see you on the next Massive Passive Cash Flow podcast next week. Bye-bye.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.